Wall Street is near record highs. Inflation shows signs of cooling, but the labor market is weakening. Consumers are becoming increasingly pessimistic. Oil remains elevated, and long term Treasury yields are moving in the opposite direction investors might expect from a slowing economy. This is the contradiction facing markets this week. The market is pricing stabilization, the economy is showing strain, and the Federal Reserve is still confronting an inflation problem being amplified by energy. So the question is no longer simply whether the Fed raises rates again. The bigger question is whether markets are pricing a soft landing that the economic data can actually deliver. Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is the Market Compass for the week ahead for Monday, August 17th, 2026. Last week gave investors something encouraging on inflation, but beneath the headline numbers was a much more complicated story. July consumer prices rose just 0.1% for the month, while annual headline inflation eased slightly to 3.4%. But here's an unusual relationship worth understanding. Core inflation, which removes food and energy, was only 2.5%. Why is headline inflation running almost a full percentage point above core? Energy. Energy prices are now 14.7% higher than they were a year ago. So while underlying inflation appears to be moderating, elevated energy costs are keeping headline inflation significantly higher. That makes oil much more than a geopolitical story. It's becoming part of the Federal Reserve story again. So let's look at last week. Stocks largely took the mixed economic picture in stride. For the week, the S&P 500 gained 0.4%. The Nasdaq added 0.1%, and small cap Russell 2000 stocks gained 1.1%. The Dow declined 0.6%. The S&P 500 and Russell 2000 also reached record highs during the week before stocks pulled back on Friday. But there's an important disconnect underneath those record levels. July payrolls declined by 23,000 jobs. May and June payroll growth was also revised lower by a combined 103,000 jobs. Then on Friday, retail sales fell by 0.6% in July. But perspective matters. Retail sales were still 5% higher than a year earlier. So this is evidence of a softer month, not evidence that the American consumer has collapsed. Consumer confidence, however, is telling us something more concerning. The University of Michigan's preliminary consumer sentiment index fell to just 51.0 in August, down from 55.2 in July. And perhaps even more important, only 8% of consumers surveyed expect their incomes to grow faster than inflation over the coming year. Year-ahead inflation expectations also increased to 4.3%. Think about that disconnect. Stocks near record highs while consumer sentiment is at 51.0. That is exactly why we keep saying market expectations are not actual economic conditions. And this brings us to this week's Market Compass thesis. The market is trying to price three different forces simultaneously. First, weaker employment, potentially softer consumer spending, slower economic growth, less pressure for additional Fed tightening, potential supportive conditions for equities. But at the same time, higher energy costs, higher transportation and production expenses, additional inflation pressure, potentially higher long-term interest rates, and pressure on consumers and corporate margins. And then we have the bond market. The 10-year Treasury yield finished the week around 4.70%. Why should stock investors care? Because higher long-term yields increase the discount rate applied to future corporate earnings. That can pressure equity valuations, particularly for companies whose valuations depend heavily on profits expected years into the future. Higher yields also give investors a more competitive alternative to stock through the bond market. So softer economic data does not automatically mean lower long-term rates. The bond market is also thinking about inflation, oil, government borrowing, and fiscal conditions. Now we get to the next test. Tuesday brings July housing starts and building permits. Housing is particularly important because it gives us another look at an economy operating under relatively high borrowing costs. The report is scheduled for 8:30 a.m. Tuesday morning. Then Wednesday brings the minutes from the Federal Reserve's July 28th and 29th meeting. And there is an important piece of chronology here. At that July meeting, the Fed kept rates at 3.5 to 3.75% by a 9-3 vote. The three dissenters actually wanted rates higher, not lower. But that meeting occurred before investors learned that July payrolls had declined and that May and June unemployment had been revised substantially lower. That makes Wednesday's minutes especially interesting. We will be reading what policymakers thought about inflation and growth before they had some of the weaker labor market information we have today. The question becomes, has the economic argument changed since the Fed was last in the room? And while government data gives us the macroeconomic backdrop, corporate earnings will show us the real-world impact. Home Depot reports on Tuesday. Target and Lowe's report on Wednesday. Walmart reports on Thursday. Together, these companies create one of the most useful consumer stress tests of the earnings season. I will be watching three things. Are consumers spending? Are they becoming more selective about discretionary purchases? Are the companies absorbing higher costs or successfully passing those costs along through prices? Retail sales tell us how much people spent. Retail earnings can help tell us how they are spending and what corporate America is seeing underneath the headline numbers. Then there's energy. Middle East tensions remain elevated. Shipping through the Strait of Hormuz remains disrupted, and Brent crude remains around the upper $80 range despite weaker global demand helping prevent an even larger increase in prices. That's an important balancing mechanism. Geopolitical risks push oil higher. Weaker demand pushes against it. But remember, stabilization is not normalization. Oil holding below some of the extreme levels investors feared earlier does not mean the geopolitical risk has disappeared. And if oil moves materially higher again, the transmission mechanism is straightforward. Oil affects transportation and production costs, inflation, Federal Reserve policy, Treasury yields, equity valuations. So what does this mean for investors? For investors with a higher risk tolerance, strong markets can continue to offer long-term opportunities, particularly in quality businesses with durable earnings and healthy balance sheets. But record highs are not an invitation to abandon diversification or to chase recent winners or ignore position size. For investors with a lower risk tolerance, today's elevated bond yields continue to make quality fixed income strategies, diversification, and liquidity relevant components of portfolio construction. Different risk tolerance, some disciplined principles, and remember, the objective is not to predict the next Fed decision. The objective is to have a portfolio capable of functioning whether the next economic surprise comes in stronger or weaker than expecting. As we head into this week, I'm watching three things. First, the Fed minutes and what they reveal about how policymakers were balancing inflation against growth before receiving the latest week labor data. Two, Walmart, Target, Home Depot, and Lowe's, because they may give us one of the clearest pictures yet of the condition of the American consumer. And three, oil and the 10-year Treasury yield, because those two markets may ultimately tell us more about inflation and financial conditions than another record in the stock market. Markets are pricing stabilization, but stabilization is not normalization. And record stock prices do not necessarily mean the underlying economy is equally strong. Markets price expectations, the economy delivers reality. And disciplined investors need to understand the difference. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.